Hi, I'm Bill Needham with the Home Buyer and Sales Team with RE/MAX 4000. Curious what best home loan options will increase your buying power? Here from Academy Mortgage, we have Mary Jane Douma, a local expert, to explain the various loan types that would be available.
Thank you, Bill.
Hey, Mary Jane was wondering what are the different loan types and down payment options that might be available with loans?
So the different loan types, if you start with the lowest down payment option, we're going to have a VA loan, but obviously you have to be a veteran for that, but it's 100% financing. We have a USDA loan, it's also 100% financing. That is area specific, so the property has to be eligible to be able to use that product. Such as, any of the rural areas, so pretty much east of 32 road, and then pretty much the Fruita area. And if you go, there are some areas a little bit closer that are USDA eligible, but we have to look up the specific addresses. And then we move into FHA, which is probably the most common loan type that we use, and that's because it is easier to get into than most other loan products. So when I say easier, they're more limited, or they're more flexible on credit and employment history, that type of thing. It's 3.5% down. We typically piggyback that with Colorado Housing and Finance Authority to help with down payment assistance for first-time home buyers, and not necessarily first-time home buyers, but other, if just somebody needs some assistance with that down payment. And then we can jump to a conventional loan, a little stricter product, and it is as low as 3% down. Typically that one has to be a first-time home buyer. But we can also piggyback that with CHFA as well. Again, income limited programs with CHFA, so we just have to make sure that they fit into that guideline, but that's the gist of what the programs are that are available.
So why might they go with an FHA loan versus a conventional loan if they qualified for either?
Well, it really just depends. With a conventional loan, the two main differences is mortgage insurance is the big one. So mortgage insurance insures the lender in case of default. So if you default on the mortgage, it makes sure that me as the lender is whole again. So it pays me back if I can't recoup my investment. So with a conventional loan, that mortgage insurance is based off the down payment and the credit score. So the higher the down payment, the higher the credit score, the lower the mortgage insurance. FHA, across the board, it's the same for everybody. It's an upfront amount that's added to your loan, and then there's a monthly amount as well.
Today, what are the typical requirements for credit scores, job history, and that type of thing? I know it depends on the type of loan. What might be the, can you give any guideline, any just even rough guidelines, or what the bottom numbers would be for the for the FHA loans?
Yeah, so FHA typically will go to 580 on a credit score. Okay. It will cost in the interest rate. The interest rate will increase. And then conventional will go to 620. They're very difficult to get done, so it's not like just because you have a 620 you're going to get that loan approved. So again, you kind of have to evaluate the whole picture when looking at that. Typically, we want to do credit counseling to help you get that score higher before you actually find a property, so that we can help get a better interest rate, or help if you're doing conventional with mortgage insurance getting a better rate through a higher credit score.
Okay, job history. Again, because I heard you mention something about CHFA being a lot more lax as far as if you're changing jobs and that type of thing. Mm-hmm. Now, by changing jobs, is that more changing job types or changing companies that you work with?
It's careers, like changing careers altogether.
Careers, right.
So FHA really is the most lenient, and so regardless, we need a 2-year work history. Now, if you've had gaps in your employment, then we have to evaluate that. The current rule of thumb, or the current rule for specifically FHA, is that if you've had a gap of 6 months or more, then we want you to be on your current job for 6 months before we can use your income. But you can change careers completely. Now, conventional, they want you to be in the same line of work for 2 years.
What kind of special program has Academy been coming up with? I heard something about a lock and shop, I believe it was.
Yes.
I wondered what that was and how that might work.
So it's a great product as long as you have some inventory, because you can lock for 90 days. So when you start your home search, you lock in the interest rate, costs $500. That $500 is refundable to you at closing, but you have to close by the end of the 90 days. So that doesn't, with a market where there's not a lot of houses, it's hard to make sure you're going to get one in that 90-day period and close. But during that time, if rates were to drop, you can grab that lower rate 30 days before you close. So it's just a way of securing in the volatile market of interest rates.
Okay.
Is that?
And so it's you've got to close within 90 days of the time that you sign up for that program.
Right.
And make the payment. You say it was $500 initial payment, but again, if you do close, that comes back to you as part of your closing cost anyway.
Correct.
Now, as part of your closing cost, or could it even be considered part of your down payment?
As long as it came from your pocket,
Mhm.
and we can prove that, it could be part of your
Could be down to your down payment. I'm just trying to think in the situation that if closing costs were going to be paid by the seller, whether you would still manage to get that $500 back, and it sounds like you if you do it properly, it would happen.
Yep.
Okay.
Yep.
Also heard that you're coming up with some newer ARM programs. I know both the lock and shop and these ARM programs are something that we really haven't had much need for in the last couple years. But with current interest rates being a little bit more in flux, both of those may come into play a little bit more. Can you tell me a little bit about what you are offering as far as ARMs go, and explain ARMs, adjustable rate mortgages?
Yep. So right now, in my opinion, an adjustable rate mortgage is not worth it. So what I mean by that is, typically an adjustable rate mortgage is starting out at a lower rate than a 30-year fixed rate. So an adjustable rate, currently we have a 5, 7, and a 10-year. So what that means is initially your rate is locked, but let's just use the 5-year for 5 years. At the end of the 5 years, it'll have an adjustment period, and your rate will go up or go down based off of whatever your margin and index are. And then every 6 months after that, your rate adjusts again, hence the adjustment, right? So what happens is you want to start, what you'd like to see is that rate starts out considerably lower. So if you have a 5-year ARM, so you're fixed for 5 years, and depending on what the terms of that ARM are, the old ARMs used to be a 5-2-5. So it could adjust as much as 5 points on the first adjustment, and then 2 points every year after that. Well, now they've changed the ARMs a little bit, and now they're 6-month ARMs. So after the first initial adjustment, then it adjusts every 6 months. So, really what you hope is happening is that you're going to see those rates go down, and you could refinance and lock into a fixed rate, lower rate. But this gives you a lower rate, but then you have the risk of the rate going up at the end of that term as well.
Any other type of loan programs that are coming up you've heard about, or that we have not discussed to this point?
The only one that I can think of at the moment is we have an extended lock. So let's say you're doing a new construction and you're not going to be done for 6 months. We can lock your interest rate in for 6 months. Works similar to that lock and shop program, where there's an upfront fee that's refundable to you at closing. You lock at a little bit higher rate than current market rate, but then within 60 days of closing, you have that float down option. So it gives you that security of knowing that you're going to be pretty close to what today's market is. And in the future, if that rate goes down, you can jump down and grab that as well. So that's one.
Maybe give me just a real brief synopsis of Academy Mortgage for those people that have not heard of Academy Mortgage.
It's great. So we're a privately owned mortgage company based out of Draper, Utah.
That's near Salt Lake City, right?
It is a suburb of Salt Lake City. They've been in business for years, many years. Same owner, and he's still around today. Obviously, he's retired, but and then we're in, I think it's 46 or 40 something states right now. So we can do loans pretty much anywhere that you need a loan done. And they're a big advocate of giving back to the community. And so we do a lot of give back to community all over the United States through Academy Mortgage.
Mary Jane, thank you for the information and everything. And if we've got any other questions, we'll certainly get in touch with you.
Thank you. It's my pleasure.
Thank you for watching this video, and be sure to subscribe so that you don't miss any important future information. Are you paying mortgage insurance on a conventional loan? If you are, there's a good chance that today, with the increase in home values that we've gotten over the last several years, this can be eliminated. To find out details, click on the link below in the description.